Hello and welcome to our latest Insider interview. Today in the studio I have with me Rebecca Maclean, Fund Manager of the Dunedin Income Growth Investment Trust. Rebecca, thanks for your time today.
It's a pleasure to be here again. Great to see you.
So Rebecca, we're heading into 2026. What would you say is the biggest reason to be fearful and the biggest reason to be cheerful for investors this year?
Well, it's been a good year for performance if you look across global markets generally. So they perform strongly, but it has been driven by a narrow set of companies. And I think there's increasing investor concerns around pockets of the market, particularly in the US in terms of the level of concentration in that market. So I think that's something that there's more concern around with investors, and that potentially something to be fearful of. In terms of what to be cheerful about, I look at the portfolio, I feel very positive about the prospects for the companies in the portfolio. There are, companies which have not enjoyed the rally that we've seen in markets and have been left behind and I think overlooked. And I think there are some great opportunities there. A company like Relics, which has sold off around concerns around AI disintermediation, but actually the company is harnessing the power of AI to improve the value of its products, save time for its clients like lawyers, and I think that's not appreciated by the market. Other aspects looking at the portfolio, there are lots of sort of different idiosyncratic investment cases within there. So a company like Haleon, which is transitioning from being within a pharmaceutical business to being a consumer health business, that provides the potential for the company to unlock value by changing the way that it operates. And so we're looking for those types of investment cases where these are quality businesses exposed to attractive markets with strong market positions and strong management teams, which will allow the companies to navigate through uncertainty to deliver attractive total return from this point forward. So I feel pretty optimistic about the portfolio and where we're positioned today.
When it comes to dividends, when you're looking for opportunities across the market, are there any sectors or types of companies in which you think dividends are looking particularly vulnerable in 2026?
It's a good question. The UK market's known for its dividend paying, but actually if you look under the hood, the dividends paid by the UK market are in a handful of companies and are highly concentrated. So 40% of the dividends paid last year were in banking, mining and energy. And these are typically cyclical sectors which are dependent on external factors like interest rates or commodity prices. So I think if you look at the track record of the dividend payments of the UK market, again, it's quite patchy. So in the top 8 dividend payers last year, 5 of them have cut their dividend in the last 15 years. So I do fear that the dividend yield on the market is probably more risky than people expect. So what do we do? We're looking for resilient income. So we're looking for companies where we've got a high level of confidence that company can continue to pay that dividend because they've got strong financials, cash flows to back them up and healthy balance sheets. And this translates into a more resilient income stream from the portfolio. If we look back at COVID, which was the last time we had a bear market, the dividend payments of the UK market fell about 30%. The dividends paid on the portfolio for Dunedin Income Growth fell 10%. So it's demonstrating that greater resilience. And I think, being really cognizant of the concentration of where the dividends are coming from and just making sure you're not overly reliant on a particular sector or theme or a commodity or interest rates, then that's the way that you can smooth those dividend payments and make sure that they're more resilient through the cycle.
For investors that have just simply owned the market, the FTSE All-Share year to date has had a good year. How would you convince investors to back your strategy? And could you talk through, it has been a tricky period of performance against that index over 1, 3 and 5 years. Could you talk through that?
Yes, so the UK market's performed well this year and Dunedin Income Growth has lagged the market. And the reason for this is more about things that we've not owned rather than things that we have owned. So the UK market has performed well, but it's been concentrated in a handful of sectors. So banking sector has done very well, aerospace and defence, and so has tobacco. But when we look forward from this point, I feel good about the prospects, because not owning those sectors that have performed well, they're not necessarily going to perform well in the future. So for example, the banking sector has performed very well, but it's re-rated from a 30% discount to book value to a 30% premium, which has been a material re-rating. And if we think the interest rates have peaked, then that tailwind from an earnings perspective from interest rates is probably not as strong going forward. Similarly, for the aerospace and defence sector, it's up 85% in the last year. And this is on anticipation of greater budgets investing in defence assets. And there's a question mark about whether those earnings will actually come through. So the sectors that we've not owned have performed well, and that accounts for some of the underperformance. And from where we stand today, I think that I would be looking at those assets that have been left behind. And for me, there's quality aspects of the market. Quality companies have been underappreciated and haven't enjoyed that rally. Also, small and mid-cap companies. So the returns of the FTSE 100, which are the largest businesses, have outperformed the mid-cap index, the FTSE 250, materially this year. And those mid-cap businesses historically have grown their earnings faster than the large caps, because they're more typically in more mature markets too. So I would be looking at quality and also mid-cap, and that's how we're positioned in the portfolio when we look ahead to see how we think the market will perform going forward.
The UK market, it's been described as cheap for many years. It's had a strong showing in 2025. Is the UK market still cheap? Are you still finding plenty of opportunities?
The market has re-rated from a highly discounted levels where it was trading below its historic PE. So it's re-rated to about 13.5 times price to earnings ratio. It's still cheap versus other markets, but it's not as cheap as it was. But as I sort of said, that it is concentrated in a handful of stocks. And if you look under the hood, there are still areas of the market which I think are unloved and are a fantastic hunting ground for investors looking to invest in the UK. So quality as a factor has underperformed value as a style materially in the last year and 3 years. So those quality businesses, these are companies which deliver resilient growth, they've got strong balance sheets, they've got competitive moats. Those companies have been left behind. So I think that's an exciting area of the market to look at. And also mid caps and small caps too. The UK market had sort of persistent outflows, and that has impacted those smaller businesses because there's less liquidity in those names too. So I'd be looking at the mid and small cap sector. And also UK as well. I mean, the UK cyclical businesses are still close to trough. So think about house building sector. We own Taylor Wimpey. We also own Genuit, which makes plastic pipes that go into residential, but also commercial buildings, and also around climate management systems as well. These businesses are trading towards the trough of their cycle in terms of volumes. And so there's potential there for a cyclical recovery in some of those domestic cyclical businesses as well, which we have exposure to.
In terms of the wider macroeconomic backdrop, how does that fit into your stock picking? And when you have an event that's pretty left field, like US tariffs, how do you navigate that risk?
So we're able to leverage the economics team at Aberdeen. So we have a macroeconomic team of experts, and they provide timely research on all these factors, and they provide forecasts around GDP and inflation, interest rates too. And so we're able to consider that and integrate that from a top-down perspective in our analysis. But we spend a lot of time on the bottom up. So we spend a lot of time speaking to the companies, speaking to them about what they're seeing. What are those leading indicators that they're looking for, and how can they manage those risks? So in the example of tariffs, it was quite a shift in terms of sentiment and narrative for businesses. We spoke to our businesses to understand where are they facing the tariffs and what can they do to mitigate those tariffs. In some situations, it came down to how strong was their ability to pass that price on. And in other situations, actually, there was a competitive advantage. So we own Volvo in the portfolio, which has its operations in the United States, where its competitors have operations in Mexico. And so it has seeing market share gains from that perspective too. So it really comes down to sort of understanding the fundamentals of the businesses that we invest in, and then looking for investment cases where we feel that these are the quality businesses which can deliver attractive total return, resilient income that we think are underappreciated by the market.
And finally, do you have skin in the game?
Yes, I do. I own shares in Dunedin Income Growth Investment Trust, and I also own it in the junior ISAs for my 2 small children as well. So, absolutely.
Rebecca, thank you for your time today.
Thank you for having me.
So that's it for our latest Insider interview. Hope you've enjoyed it. For more videos in the series, do hit that subscribe button, and I'll hopefully see you again next time.